Hi, I am Ermin. I am co-founder and CEO of Aegis. We are building institutional-grade yield-bearing stablecoins with DeFi compatibility. So we launched last year in March. We gathered around 50 million of TVL at peak. Right now we're sitting at around 40. We have integrations with DEXs and SEXs. Our yield-bearing stablecoins are used as trading collateral across all orderly-based DEXs, including Radium. We also have integration with UX, so it's a SEX integration. We are deployed across multiple chains, including Ethereum, Katana, Base, Avalanche, and others. We have deep partnerships with them, including some incentives for the end users. We also deployed across lending markets like Morpho, Gearbox, Euler. We worked with the biggest curators and TVL providers in the space. Most of them became investors on our cap table, including like Flowdesk. And we had one of the second biggest pool on Euler on BNB chain in terms of TVL, and we had one of the best performing pools in terms of APY on Pendle. So yeah, when it comes to the core products, we have two stablecoins. The first one is BTC-backed, basically BTC basis trade stablecoin. What we do, we go long BTC and we hedge it one-to-one with BTC margin perpetual shorts. We earn funding rate on our short positions. We distribute it as a yield. We take 10% performance fee cut from that. And that's basically how this product works. Why we chose BTC margin perps to hedge Bitcoin is basically that we put risk management on the first place. So we didn't want to have any exposure to other stable coins or have a risk of liquidation on the short side. So basically with BTC margin perps, you are protected from that. In case if you are using USDT margin perps, anything happens with the USDT, let's say a DPAG, you can be liquidated on the short side. So we don't have that risk because we are using BTC margined futures. And we also have another stablecoin with a JLP Hedge strategy. What we do, we buy JLP, which is a native token of Jupiter Exchange on Solana. It has inherent yield embedded into it. Basically, they're accumulating fees from the trading on Jupiter and liquidation fees. And we hedge everything that is inside of JLP because JLP acts as an index. So they have Bitcoin, Solana, Ethereum in it. So we hedge that, and we have yield from JLP, and we have yield from the funding rates on the short side. And on both of the products, we are delta neutral, and we don't use leverage. So essentially, that means we are not exposed to the movement of the underlying assets, and also we don't have any leverage. So in case of the severe price movements in the underlying assets, we are kind of like protected from that. And the yield is, you can see the yield, the current yield on both products. So yeah, and one of the features that we introduced with these stable coins, because if you look at the overall market, in order to receive yield, you need to have staking or stake the stable coin in order to receive yield. In our case, you don't need that. So basically, we have direct yield feature. So any product, any fintech app, we have proven that with orderly network integration and VUX. So basically, user just buys our stablecoin and holds it on a wallet or on their account, and they don't need to do anything with it. They receive yield directly. They don't need to do staking. But we have staking options as well. So if a DeFi native user prefers staking, we have staking as well. So we did multiple integrations. We are talking to some crypto wallets like Coinomi and some guys like EtherFi about this product integration. And we obviously have stablecoin as a service because we have rigorous infrastructure in place, including smart contracts and also custody infrastructure. For both of our products, we use Copper and Cephu. So that means we never move the collateral to the exchange itself when we perform the trading. So it sits within the custody, and the settlement happens off-chain through the Clearloop solution and MirrorX. So yeah, the stablecoin as a service, we kind of like provide this infrastructure to fintech apps, to banks who are interested in launching their own stablecoins or even DeFi projects. We have 3 customers in the pipeline. Unfortunately, I cannot reveal the names, but this product is also getting some product market fit. In terms of the team, I'm a co-founder and CEO. My background is in finance. The rest of the team is mostly DeFi native guys and also guys with the HFT background. In terms of advisors, we have pretty strong names as well, like head of crypto at Layer 0, and also stablecoin lead at Pendle, and the ex-director of Paradigm and UBS. So yeah, why do we have the edge, and what's our edge? It's basically our background and our core backers. It's Riverside Hedge, which is one of the biggest market makers in the space. They do around 30 billion monthly trading volumes across sexes and dexes. They are like top 4 on Aster and top 5 on Lighter in terms of volumes. And they transferred part of their team and trading technology to us. So everything that we do when it comes to trading and executing the strategies, we do in-house. So we don't rely on any external parties, what you would usually see in some DeFi protocols. So we control the risk management and the trading operation side in-house. So yeah, in terms of the roadmap, I think we are focusing on improving our risk management practices and launching new products that would diversify our yield. As you may know, the real trend is RWAs, so we're looking into that as well. We have a plan to diversify the yield and include some RWAs, specifically CLOs, tokenized CLOs, as a part of our portfolio and the backing. And we have a good partner for that. We are talking to multiple parties like Maple and Galaxy to co-launch this product. So yeah, I think in terms of the next steps, we will be focusing on diversifying the portfolio and scaling the TVL through multiple integrations with crypto cards, DeFi wallets, and fintech apps. So yeah, that's it from my side. So yeah, you can visit our website, which is aegis.im, and check out the products yourself. Thank you.
How do we start? Okay. So I will have first question for you. Thanks for presentation. So my question is, like, how sustainable is the yield API you showed, 10% on stable and 6.5 on Bitcoin? Because the main source is it's perpetual funding rate, right?
That's correct.
That one can get even negative in certain scenarios.
That's a good question. So if you look historically, like for the past 5 years, 87% of the time funding rates were positive, and only 13% they were negative. That's actually what we see currently in the market. But if you average out for the past 5 years, the average APY was around 10% on the funding rate, on this basis rate strategy. On the JLP hedge side, that is also dependent on the market. Obviously, retail, activity of the retail dropped off significantly. So open interest on GLP dropped off as well. You currently cannot earn this 10%, but you can easily. So what the yield that we get right now is around 7%. So for the past year, it was 15%. So once the retail comes back, the yields will get back as well. But that's why we are looking to diversify into more, let's say, uncorrelated strategies, so that we have this diversification in case there is a bear market. But yeah, so the yields are not sustainable short term, but long term, they're pretty stable.
Okay, thanks.
So I've seen you've got multiple audits, but how do you handle the operational security? I guess a lot of things happen off-chain. How are users safe giving you their money off-chain?
Yeah, that's a good question, and I think specifically after the Resolve incident. So we don't. When we design the protocol from the beginning, first of all, we don't have any God mode admin role that can basically execute mint that is uncollateralized. And we also have different protection mechanisms. You cannot be protected from that 100%, right? But what we do systematic reviews of the operational security. We also have mint caps, so you cannot mint unlimited amount of YUSD or JUSD. We also have oracle checks. So whenever the mint transaction is happening, there is an oracle, Chainlink, Redstone, that are checking the price of the underlying. And underlying is only USDT or USDC, so you cannot mint with an exotic asset our stablecoin. And the third thing is basically, there is no one private key or AOA that can sign the transaction or get the rights to mint without KYC and KYB. So every minter, we basically know them because there is a mandatory KYB, KYC for that.
Thank you.
I had a couple questions for you. One is, how are you different than Athena? Two is, who is your counterparty for your perps and your futures? And what are your major risks?
Yeah, so basically how we're different from Athena. So Athena is kind of like abandoning delta neutral strategy in general. But at the beginning, they were using USDT margin perps to hedge the positions. And that's the main differentiator. So we don't use USDT margin perps to hedge the positions. So we don't have the USDT risk embedded into us. In the case of Athena, if something happens with USDT, because your quote asset is USDT, BTC-USDT pair will shoot up in price if USDT debacks. And that means, and you are holding short against your Bitcoin or like Ethereum, doesn't matter. So basically the price will shoot up and you get liquidated on the short side. That means you lose the collateral. If you lose the collateral, you lose the peg. In our case, it's BTC margin perps. So anything happens with USDT or other assets, our quote asset is USD. So liquidation risk is super, super small. And the counterparties, we hedge on OKX and Bybit and Binance. These are like our main venues. So on those venues, you have different protection mechanisms. Obviously, you are not protected 100%, but that's the same for every, trader or project that is doing some hedging on the centralized exchanges. So yeah, the counterparty is basically other traders on OKX, Bybit, Binance, I suppose, yeah. And we also, one good thing to mention, we have basically the ADL, also kind of like always mentioned by investors and LPs, like how I protect from ADL. And ADL protection is already embedded into those exchanges as a feature. So before you needed to agree with the exchange, but now you have that as a feature.